Hello, this is Craig Tashton with Fairway Independent Mortgage. We're located in Needham, Massachusetts. We are a local branch of a national lender, Fairway Independent Mortgage out of Madison, Wisconsin. What I wanted to show you here was a quick rent versus own video. Many people who are renting right now or first-time home buyers are thinking about buying given that interest rates are at historic lows and home prices have come down also since over the last 4, 5, 6, 7 years. So in the first column here is let's say a typical rent for the greater Boston area, maybe out to 495 area in Massachusetts. 1,500 for a decent apartment, roughly maybe $30 and other additional expenses, maybe some insurance in there. A total rent of about $1,530 per month. And beside here we have three different programs. A 3% down mass housing program where you can get into this property with as little as 3% down. The 3% down can be also a gift, from family. And the payments would be between mortgage, tax, insurance, mortgage insurance, would be about $2,500 a month. But then when you figure in the tax benefit that you would gain, and this is a conservative tax benefit, about a 15% tax bracket. Most people would fall into a little bit higher tax bracket. And also how much principal you're paying down on the loan. Each month you're paying down the loan, the principal on the loan. So your net after that is about $1,762 per month. And so that is about a little more than $200 per month in your payment. There are also other programs like FHA loans, which are an excellent loan. This allows for as little as 3.5% down. The mortgage insurance cost on these is a little bit more than a mass housing program. But they're good for people whose credit is maybe not quite as high as it should be, but it's still an excellent program with low down payment, and also allows for as little as 3.5% down, and the down payment can be a gift as well. And then the other program is more the traditional 5% down Fannie Mae loan, 30-year fixed, and those payments. All these payments are going to fall within $200 more on a net basis after tax benefit and after principal pay down of a rent of like around $1,500 or so. Now, one of the other important features of these programs is what really happens over time. So over the next 6 years, you're going to pay maybe $112,000, $113,000 in rent, and this figure is also about a 1% increase in rent, based on inflation, which inflation may be a lot higher than this, but using a modest 1% inflation rate on that. But over the next 6 years, you'd pay $112,000, $113,000 in rent. If you got a mass housing loan over that same time period, in just a short 6 years, you would actually accumulate $36,000 in principal. So that's real equity, real money if you were to sell your property, and if the property were to stay the same in value or possibly increase in value as well over that same period of time. And there's also increased with principal pay downs with these other programs as well. Now, the other thing to look at really over long term is, which is much more compelling, is what is this investment worth to me over time? Well, let's say if you had $25,000 in the bank, and instead of using that money towards down payment and closing costs and other things, you were to just leave it in the bank at a 1% return, you'd have $27,000 over 8 years. Whereas if there's a mortgage, you'd have about $114,000, $110,000, $107,000 in accumulated net worth over that 8-year period. So which one would you rather have? Would you rather keep paying your landlord's mortgage, or would you rather pay your own and gain equity and gain home ownership over time? Any questions on this analysis, please feel free to give me a call at the phone number or email address in the top right-hand corner. Thank you very much.